everyone. Welcome to KCMI Global Issue. I am Min-Ki Kim, Research Fellow at the Korea Capital Market Institute, hosting this online interview today. This is the inaugural issue of online series of KGI, and today's topic is public versus private firms and public versus private market. Now, please allow me to briefly introduce our speaker, Professor Rene Stutz, who is Everett D. List Chair of Banking and Monetary Economics and the Director of Dye Center for Research in Financial Economics at The Ohio State University. He is also Director of List of Financial Institution Group at the MBR, and he served as President of American Finance Association and Editor of Journal of Finance. This interview consists of 6 questions, and each question will be answered by a speaker. So let me start with the interview with the first question. So Professor, for the past 3 decades, what changes have occurred in the US public market?
Over the past 3 decades, there has been a dramatic change in the US public markets. The figures that you are seeing shows the number of listed firms over time, starting in 1975 and ending in 2020. You can see that the number of listed firms was higher in 1975 than it is in 2020. The number of listed firms increased until 1997. That year, there were 7,576 listed firms on US exchanges. And so by US exchanges, I mean NYSE, MX, and NASDAQ. After 1997, the number of listed firms falls sharply. By 2018, we just have 3,613 listed firms. So even though the size of the economy has grown sharply over these 3 decades, the number of listed firms hasn't. It has actually fallen since 1975. At the same time, the characteristics of firms have changed. In particular, the size of listed firms, their market capitalization has increased a lot. I'm showing here on this figure the market capitalization of the highest market capitalization firm in the US. And you can see that that market capitalization has increased dramatically since the 1990s. What I'm showing is in real dollars, in 2019 dollars. And you can see that the market capitalization of the largest firm didn't change very much from 1960 to 1990, but since then it has increased a lot. Now you know that the largest market capitalization firm in the US currently is Apple. And now in the US, we have gone to the point where we have several firms that have a market capitalization in excess of 1 trillion. At the same time, so here we have the average market capitalization, and you see the same as what we saw for the largest firm. Now, a pretty dramatic increase. So another part of this evolution is that the small firms have become very few on the exchanges. Now, if you think of a small firm as one with market capitalization less than 100 million, and by market capitalization, I mean the market value of the equity. In 1975, 61% of the listed firms had a market capitalization of less than 100 million in 2015 dollars. In 2015, it's only 22.6%. Lastly, the firms have changed in many dimensions besides size. One hugely important change is that intangible assets. Now, the assets that firms have that don't correspond to physical capital, but patents, R&D, organizational capital, and so on, that those assets have become dramatically more important than they used to. Another evolution is that firms pay out a lot more than they used to. The repurchases have increased dramatically. In the 70s, there were essentially no repurchases. Dividends were more important. Now in the US, repurchases are more important than dividends, and they are much larger in real dollars than they used to be.
Okay, thank you for the answer. The most important point is that there is a sharp decline in the number of listed firms in the US public market, but growing their size and changing in many other dimensions. So let's move on to the next question. As long as I understand, the decline in the number of listed firms could have been affected by several factors, like post-IPO and regulatory costs, agents' problems, and changes in nature of firms and growing private market. Of those, what do you think is the largest factor influencing the decline?
You are right that there are many factors. But initially, I think it's important to emphasize that the direct factors in the decline are that the US has had fewer IPOs, initial public offering, than it has had delistings. Now, IPOs is how firms come to the market. Delistings are how they exit the market. And so the figure I am showing shows the new listings, that's in blue, and the delistings, that's in red. So entry is in blue, exits are in red. And you can see that with starting in 1997, the blue line is always lower than the red line. This goes to 2012. When you go past 2012, the blue line is still lower than the red line in almost all years. And when the blue line is above the red line, it's by a tiny amount. So the bottom line, we have had too few IPOs and too many exits. And the exits come mainly through mergers. So another way to say this is that we have had a lot of mergers. So what about the factors that led to this situation? One concern that has been talked a lot in the US is too much regulation following Regulation Fair Disclosure on the Sarbanes-Oxley Act, the SOX Act. The problem with that is if you look at the figure, the decline in the IPOs precedes the Sarbanes-Oxley Act by several years. Now, Sarbanes-Oxley was in 2002. It didn't really come into effect until 2003, and the provisions that people object to came into effect even later. So the timing doesn't work for Sarbanes-Oxley. What about agency problems? Now, what we mean by that is that there are conflicts between managers and shareholders. Managers pursue their own interests, and so shareholders want to make sure that they receive a return out of investing in firms. And that requires them to find ways to make sure that managers act in the interest of the shareholders. These agency problems are different between young firms and old firms. Now, old firms are established. They are generally profitable, now if they have lasted. And you want them to make good use of the cash flows that they generate. Small firms are not established. They are investing massively. And currently, they're investing a lot in intangible assets. So you really don't want them to invest more than they should. And it's really difficult to figure out what the right amount of investment is. For public firms, shareholders can't do much because it's difficult to figure out whether the amount of investment is right without being an insider. For public firms, management has to disclose a lot, but essentially those disclosures make it risky for the firm, create a risk for the firm that other firms could take advantage of it by knowing what it is up to. So disclosures of public firms for young firms are dangerous, and managing the conflict of interest between managers and shareholders is extremely difficult. If the firm is private, it has few shareholders, and they are essentially insiders. They can figure out what is going on. So for when intangible capital is important for young firms, when they are building that intangible capital, the private firm organization is generally better. So having more intangible capital also means that there are more firms for which the private form of organization is better. And so now the change in intangible assets is important, but so is the fact that young firms are building intangible assets, and that process has to be managed carefully, and the private firm is the best way to do that. Now, the public markets know how to value intangible assets. Now, when you look at Apple, obviously most of the market capitalization of Apple, or at least a very large share, is due to intangible assets. But those intangible assets are established, they are recognizable. Nobody can come and steal them. Ideas are easy to steal. On new firms have really ideas that they're working on. The private, so it would be difficult to have a lot of private firms if the private markets had not grown pretty dramatically. So we have the growth of intangible assets, and we have the ability to fund that through private firms because of the growth in private equity and venture. Okay, and here I show, using the Bain report of 2021, the global private capital raised since 2003. And you can see that there has been a dramatic increase in the amount of private funding raised over that period of time, where in 2019, it's exactly 10 times what it was in 2003. So private firms build intangible capital. That's now has become much more important. And the ability to fund that privately has increased dramatically.
Okay, thank you for sharing your insight. You point out that more direct factors or fewer IPOs, but increased delisting, most of due to M&A. Furthermore, you point out that the increased intangible assets and growing private market as another significant factor. That leads to my next question. Do you believe the declining number of listed firms is a phenomenon specific to the US? If you do, what do you think that makes the US different?
That's a very interesting question. And my thinking about that has evolved a bit. Now, initially, when I started this research, we only were seeing the decline in the US. And so the question then was, is that something unique in the US that has to be explained by what's going on in the US? Or is the US simply early? Okay, and then at that time, I had research done with Andrew Cowley, who is at Cornell, on Craig Deutsch, who is at the University of Toronto. And we developed this concept of a listing gap. Now, and what we showed is if the rate of listing in the US was the same as what it is in foreign countries, given the characteristics of those countries, then the US should have a lot more listed firms. And so that's our estimate. You see on the figure, our estimate of the listing gap over time. And it turns out to be very large. Okay, in the sense that in 2012, which is when this figure ends, the listing gap was such that had the US the same rate of listed firms as foreign or other countries, it would have more than twice as many listed firms. However, when you look at the UK, for instance, the UK has a pretty sharp decrease in listings as well, but it starts 7 or 8 years after it starts in the US. Okay, and so compared to the UK, you might well say that the US was just early. And you see a bit of that decrease in other countries, in other developed countries as well. So here we can look at the evolution of listings in the rest of the world. I have 2 lines for the US. There's no point to worry about why. Both lines show the same evolution, and it's the evolution that I discussed with my first slide. Okay, when you look at the red dotted line, that line here, that's the listings throughout the world, except for the US. And you can see that listings increased pretty sharply from the early 80s to the early 2000s in the rest of the world. Be careful to note that the left vertical axis is for the US, and the right vertical axis is for the rest of the world. Okay, and so the world is at about 40,000 listed firms compared to the US, which is at about 3,700. So you see the evolution of the world is very different. But at the same time, eventually the number of listed firms stops growing in the rest of the world. It doesn't decrease, but it stops growing. And you can see the green line is non-US developed countries. And you see that about the same type of evolution as for the rest of the world, but not dramatic. And then when you look at Western Europe there, now you can see somewhat of a decrease after the global financial crisis. So bottom line, the decrease in the US is really dramatic. It's really large. When you look at other regions of the world, there's nothing like it. But there is a large decrease in the UK. Across the world, the number of listings has kind of stopped increasing. So you might say, well, is there something that enables us to make sense of this? One thing we know is that the rate of investment in intangible assets, now in R&D, organizational capital, and so on, that rate of investment tends to be higher in some countries than others. And it tends to be high in the US. Now, and so if you think that somehow because of the institutions of the US, or for whatever reason, investment in intangible capital is higher in the US, then kind of this makes a lot of sense. Now, as after the 90s, we went to a world where young firms invest much more in intangible capital than physical capital, then that evolution was sharper in the US than in other countries. And therefore, the need for private firm financing was sharper in the US than in other countries. But PE funding increased pretty dramatically in the US. Now, I mean, just to make sure we are all on the same page here. Now, when you think of a young firm in the 1970s, it tends to be a firm in manufacturing that needs to go to the public market to buy plants. Okay, and so when you think of young firms in the 2000s, now the extreme cases are like Facebook, like Instagram. Now those firms have hardly any physical capital, but they have a lot of intangible capital. So they don't really need to go to the market to raise funds, but they needed a lot of funds to build that intangible capital while they were still private. or not necessarily a lot of funds in the case of Instagram, but they built the intangible capital while they were still largely private, because that's the best way to do it.
Okay, you mean that US is different, but not totally different from other countries that have also seen the number of listings declining. Furthermore, you mentioned that US specific factor might be growing importance of intangible asset and the low PE. Okay, then, do you believe so-called eclipse of public firms? Will the private market replace the public market going forward?
That's a difficult question to answer. It's also kind of a weird question when we are in 2001, given what happened in the US with public markets over the last 7-8 months. Now in the US, we have this phenomenon called SPAC, which is a special purpose acquisition company. There has been just dramatic number of new SPACs being created. And so those companies are created essentially through an IPO. Now they go to the public markets, they raise funds, and they say, we are going to merge with some company, but we are not going to tell you which one. We are going to figure it out later. Okay, and so if you look at IPOs and include SPACs, there are a lot of IPOs last year, and there are a lot of IPOs this year. So you might say, well, gee, does this mean that everything I talked about is over? The answer is probably not. The answer is probably we'll go back to where we were. No, it's the period that we have right now is exceptional in many ways. But one way it is exceptional is the incredibly high valuations of some sectors. And when you have very high valuations, then firms that otherwise wouldn't go public, or firms that are waited to go public, are going to time the market and take advantage of that. So the period that we have is exceptional. Eventually, we'll go back to a normal period in terms of valuations. We are going to go back to the world we were in some ways, not in all. Then we may really be back to having very few IPOs, and we are likely to have more delistings again than what we have right now. Now, it's a fascinating time, because if you thought about it in March 2020, now anybody's forecast, or at least I don't know anybody with a different forecast, would have been, we are going to have a lot of delistings as firms get in trouble. We are not going to have IPOs because the markets are not being receptive. We ended up having exactly the opposite of that.
Okay, so given the large number of SPACs, public firms won't disappear. So let me now turn to the next issue. Since COVID-19 outbreak, the retail investors have been surging to the stock market. So what implication does it have for the change in public market and growth in the private market?
Well, that's what's going on is absolutely fascinating. But it's also something that's pretty temporary. Now, there's a lot of discussion in the US of people getting stimulus checks. Now, the federal government sends checks to individuals whose income was below some level. So there's a lot of discussion of people taking the stimulus checks and putting them in Tesla or in GameStop. Okay, well, obviously they're not going to get stimulus checks again. So, no, and there's a lot of jokes about people kind of getting bored with the lockdown and spending their time investing in stocks. This is a very unusual period. Okay, I think it has had a big impact on some valuations. Now, here the figure shows the evolution of the stock price of GameStop. I mean, this is just a weird story. I mean, it's a company that was going nowhere. And suddenly some subset of retail investors became excited about it. And it experienced a huge, I mean, so it's effectively its stock price was multiplied by 10 without anything fundamental changing. No, so it's just bizarre. There are lots of other stocks like that. No, so you would say that that's not exactly a good influence of those retail investors. What is quite interesting is that now in general in finance, we think that changes in demand from a subset of investors is not really going to have much of an impact on the price, because if valuations get high, other investors are going to come in on short. But that mechanism hasn't worked at all. Now it suggests that the price impact of those investors can be large. And I think the reason it can be large is that they coordinate on web platforms. And so it's not lots of retail investors acting one at a time, but it's effectively a whole crowd of individual investors. The other thing is that they really create a danger for short sellers. No, because if you can have those irrational moves in the stock price, most short sellers were not able to stick with GameStop through that increase. And the extent of short selling has actually fallen quite a bit since then because of this, these worrisome developments. But short selling is good for the markets. No, it keeps values in check. So all of this now is in many ways worrisome. You want people to participate in the stock market, but at the same time, you want a rational stock market. What does it do for the growth in the private market? Well, I mean, there's, in some sense, once we are out of this period of extreme valuations, it probably is going to help the private markets rather than hurt them. Now, if you're a manager of a firm, you kind of worry about public markets being too fickle. And that may lead you to decide to remain private longer.
So thank you for the answer. This is the last question. So could you tell me about how is change taking place in the US market to the gap, US public market to the gap between Main Street and the Wall Street that has become evident than ever under the COVID-19 situation?
Yeah, that has been an important topic in the US that people have worried about. No, and with just reason, because when you look at what happened last year, now we had the highest unemployment since the 1930s. So just enormous rate of unemployment. And at the same time, the stock indices reached new records. Now we're never as high. So the stock market did spectacularly well after the crash, but unemployment stayed extremely high. So it creates a paradox. And the question is, how does that paradox fit in what I'm talking about? So there are really two different evolutions with the stock market. One is the evolution of the number of listed firms we talked about. But the evolution of listed firms doesn't necessarily mean that public firms as a whole become less important for the economy. Now, if half of the firms merge with the other half, then the importance for the economy of the public markets doesn't change. You just have half many firms as before. But it turns out that the public firms have become less important for the economy. The figures that I am putting up right now shows that. Okay, what that figure shows, let's just focus on industrial firms. What that figure shows is that non-financial firms in the US in 73 were about 40% of the employment in the US. So one way to think about that is that 4 out of 10 people who worked in the US worked for public firms at that time. When you look at the end, and I have several lines because you have to make all sorts of assumptions to construct those numbers. For our purpose, let's look at the light blue line with the triangles. Okay, and so unfortunately, the data is only since 1984. But what you find is in 2019, 2 workers out of 10 in the US worked for public firms. So we went from 4 workers out of 10 to 2 workers out of 10. So it's a pretty dramatic change over time. It takes place in 2 different periods. Now, the first is 70s and 90s. Now, until 1990, so 70s and 80s, there is a dramatic change. And then there is another decline in the 2000s. The decline in the 70s and 80s has to do with the decline of manufacturing. The decline in the 2000s has to do with the fact that even US firms produce less in the US than they used to and more abroad than they used to. So why this evolution? Well, it goes back to the same ideas that I have talked about, which is the importance of intangible assets. Now, in manufacturing, physical assets are really important. Now, if you're in manufacturing, you need plants and you need capital for plants. The stock market and the securities market in general are very good at financing physical assets. Now, you can look at them, you can value them in a way that is much harder with intangible assets. And so the stock market is really good for manufacturing. It's not so good for some of the other industries. Now, so in the US, you see a dramatic decrease in employment in manufacturing. The industries that are done well are the service industries. Now, that would be business services, but it's also health, education, and so on. No, and so when you think of health and education, the stock market is not particularly good for those industries. Now, a university going public doesn't generally make much sense because a university is its professors, and if the professors decide not to come to work the next day, you have no value. Okay, and so the change from manufacturing to services has had a big impact on the economic importance of stock market firms. Essentially, that economic importance, at least with respect to employment, has fallen dramatically.
So the firm in the US stock markets are now just a smaller part of the economy. So thank you, Professor, for sharing your insights on the changes taking place in the US public and private market. So I think finding the balance between public and private market will be an important policy task in the future. We hope that this KCMI Global issue will provide useful information and insight to all market participants. Thank you for watching KCMI Global issue. And this is the end of the interview.